Welcome back to Winning by Not Losing, the show where we help your portfolio stay upright, even when the market looks like it lost a fight with a flight of stairs. I'm your host, joined as always by Sudhir Hola, CEO of My Stock DNA. Sudhir, good to have you.
Great to be here. And yes, the market has been wobbling more than usual.
The Nasdaq down 7% before recovering. Gold had also dropped before recovering. Crypto seems to have walked off the cliff, giving up all its gains for the year. So today we're asking, how do you prepare, not panic? Your recent piece on Burry's AI short and Buffett's S&P struggles makes a great point. Most advisors don't build portfolios to win. They build portfolios so they can explain them.
That is right. Benchmarks become emotional safety blankets. When the S&P is down and you're down just as much, you're fine. But you're still losing. Even legends get punished for defense. Buffett underperformed because he wasn't chasing AI. Burry got roasted because he shorted hype.
So defense is unpopular until you need it. In your post Traffic Jam in the Market, you describe the rare moment when all four lanes, stocks, bonds, gold, and the US dollar, fall together.
Exactly. Since 1973, only 17 months saw all four lanes close at once. November 2025 seemed initially like it was one of them, and it felt like the world is ending. But here's the key. 76% of those all down months had at least two asset classes bounce back within 30 days. The question isn't, is the world ending? It's which lane opens first. And which lane opens first tells you about the likely economic regime we are going to transition into.
Let us talk about the start of today's show, your post on a DIY defensive portfolio that can potentially go up when markets go down.
Sure. The defensive sleeve within all the portfolios that we offer to our advisor clients actually went up 4% this month and played its role in protecting the portfolio. It is possible to build a DIY version of it with a little bit of guidance. Let's build it in a few minutes. Step one, 6 ETF positions, 10% each, GLD representing gold, IEI representing intermediate duration bonds, UUP representing US dollar, XLU representing utilities, XAR representing aerospace and defense, RWM representing inverse small caps. Why? These assets historically behave well when fear hits and have a low correlation with the overall stock market.
That gives us 60% of the portfolio. What about the remaining 40%?
Step two, using the Moneyball segmentation methodology that we explain in our book Moneyball Investing, pick companies from the S&P 500 that win when wallets tighten. For illustration, take Walmart, McDonald's, United Health, TJ Maxx each at 10%. You can try picking other stocks as well. As long as they follow the segmentation methodology in our book, you are good.
This is the part that got attention. Approximately 9% annualized return. Max monthly drawdown just 7%. Up, plus 4% in 2022. Only minus 4% in 2008. Outperformed in every major risk-off regime.
Unfortunately, defensive strategies don't win popularity contests. They win by not bleeding. They are not difficult to build.
And then you ran the exact same portfolio through Darwin.
Same ingredients, but dynamic lane selection. Result higher returns, lower risk, better consistency. But the DIY version alone is extremely effective.
Let's return to your blog post on The Market is Walking Off a Cliff. You said reaction frequency should match your vehicle.
Right. Think of day traders as bikes, Warren Buffett and other fundamental investors as trailer trucks, and retail investors as minivans. A trailer cannot change lanes like a bike and will probably lose big if it tries to do so. If you're a minivan, which most listeners are, you shouldn't weave lanes every day. Monthly or quarterly rebalancing is the sweet spot. And the worst mistake, switching vehicles when a position goes against you and reacting based on emotion instead of cadence.
All right, Sudhir, final word.
A defensive strategy isn't magic. It's math, discipline, and a little common sense. The DIY portfolio works because it's simple, diversified, and built for chaos. Defense isn't about predicting crashes, it's about surviving them.
Perfectly said. Markets can get drunk, panicked, or euphoric, but your portfolio doesn't have to. Thanks for listening to Winning by Not Losing. Check out the full blog posts in the show notes. And as always, stay calm, stay balanced, and keep winning by not losing.